Ladies and gentlemen, good day and welcome to Uniparts India Limited Q4 FY24 earnings conference call hosted by Go India Advisors. As a reminder, all participants' line will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Monali Jain from Go India Advisors. Thank you and over to you, ma'am.
Thank you, Manuja. Good evening, everyone, and welcome to Q4 and FY24 earnings call of Uniparts India Limited. We have on the call Mr. Gurdeep Soni, Chairman and Managing Director, Mr. Rohit Maheshwari, Group Chief Financial Officer, and Mr. Vivek Maheshwari, Vice President, Financial Planning and Analysis and Investor Relations. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risk that company faces. I will now request the management to take us through the financials and business updates, subsequent to which we will open the floor for questions and answers. I will now hand over to Mr. Gurdeep. Thank you, and over to you, sir.
Thank you very much. Good evening, ladies and gentlemen. I welcome you to the Q4 FY24 earnings call of Uniparts India Limited. We sincerely hope that all of you are doing very well. Prior to getting into the summary of the reported quarter, like always, I would like to reiterate that the core of our organizational functioning is guided by the principles of passion, innovation, integrity, excellence, and teamwork. The team has been working diligently and with passion over the years to establish Uniparts as a preferred supplier to the global off-highway vehicles market. We at Uniparts believe that through our off-highway focus, our well-positioned product offerings, and marquee customer portfolio, we have a robust global business model to cater to the long-term trends of food security prioritization, as well as infrastructure build-out and modernization. By way of leveraging engineering competencies and global delivery model, we are proudly partaking in building the world and feeding its people. With the above backdrop, let me spend next few minutes sharing thoughts with respect to the current operating environment and business highlights. Our Q4 FY24 closed broadly in line with the guidelines given earlier for a 10 to 12% sequential growth. Inventory corrections at customers' end are now practically behind, with only minimal sales and impact in Q4 for small agricultural OEMs. The end market near-term dynamics and volatile demand scenario persists. On the construction side of the end market, the US market for us is steady with new business driven by China Plus One and US infrastructure bill. Europe is witnessing slight softness while Japan is largely steady. On the large agricultural machines, early signals of slowdown in US large ag, as indicated in the previous 2 quarters, have started to materialize and expected to have adverse impact on demand vis-a-vis FY24. On the small agricultural machines, this segment overall declined about 50% for Uniparts in FY24. On this reduced base, the demand in near term looks steady and being monitored for any further signals. The Indian domestic tractor market has remained soft through the completed fiscal year. Recovery expectations for now are more linked to monsoon performance this year and pick up in export demand. In the aftermarket, this segment overall declined approximately 30% for Uniparts in FY24, owing to the dual impact of demand softness and aggravated by channel inventory correction. Inventory correction cycle appears to be over for now, and that part of demand is expected to normalize over the coming quarters. The end market demand is being monitored and some very early green shoots are observed. The new business pipeline is healthy. However, end market softness could lead to some elongation of implementation timelines and full revenue realization timelines in some cases. Our investment for growth continues, plus additional focus on cost optimizations are also continuing. The company's business continues to generate healthy cash flows, lending further strength to the balance sheet. We also continue to augment our digital capabilities, aiding agility and optimizations. The company has also been making meaningful strides in its CSR as well as sustainability initiatives. During the completed fiscal, we supported several social causes in the community around our manufacturing facilities. Towards sustainable energy adoption, our Vizag facility is now equipped with captive rooftop solar plants, while our Noida facilities are in the process of getting open access solar power supply. We believe that these initiatives will go a long way in generating positive impact on society and environment in which we operate. As the focus on food security and infrastructure build out by most economies in the world is continuing, this lends a long-term tailwind for the global off-highway vehicle industry. Within this long-term growth journey, propelled by regular demand for off-highway vehicles, there are likely to be shorter periods of highs and lows. Coming off the high base of 2021 and 2022 and calendar year 2023, the current fiscal 23-24 was one such year of softer demand, further accentuated by some element of channel inventory destocking. We have been focusing on utilizing such short-term lean patch by investing for growth and ensuring readiness of our facilities and resources. Our focus and efforts are aligned with the medium-term business plan for achieving the targeted growth in coming years. With this, I would like to hand over to Vivek Maheshwari to discuss the details of our financial performances during the reported quarter. Thanks, and over to you, Vivek.
Thank you, sir, and good evening all. I would like to share following financial and business highlights of the quarter and the fiscal year ending 31st March 2024. Revenues from operations for Q4 came in at rupees 290 crores, which is a quarter-on-quarter change of plus 11.8% and a year-on-year change of minus 11.7%. And for the full year, FY24 came in at 1136 crores, which is a year-on-year change of 16.6%. Reported EBITDA for Q4 was 51.5 crores, which is a quarter-on-quarter change of 16% and a year-on-year change of minus 26.5%. And reported EBITDA for full year was rupees 210.7 crores, which degrew year-on-year by approximately 32.6%. While EBITDA margin reported at 17.8% for the quarter 4 and 18.5% for the full year FY24 respectively. Operating cash flow generation for full year FY24 was approximately 200 crores. This is a result of improved working capital performance and healthy profitability despite decline in revenue. The net working capital, comprising of big three elements of inventory, account receivable and account payable, as number of days of trailing 12 months revenue from operations, stood at 152 days as on 31st March 2024. Net working capital during the fiscal year decreased by approximately 64 crores. Uniparts balance sheet continues to be net debt free, with group net cash position at approximately 113 crores at the end of March 2024. Full year cash outflow towards capex commitments has been approximately 36 crores. Inflationary pressure cost remains in the medium term, to be partially mitigated through operating efficiencies. Macro concerns about global economic slowdown, geopolitical uncertainty, and impact of worldwide high interest rates continues to remain a key monitorable. With this summary, I would like to hand the conference back to the moderator for question and answer session. Thanks very much.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Chetan Vora from Abacus Asset Managers. Please go ahead.
Yeah, hi sir. So just would like to understand that as you have mentioned that we are largely done with the inventory stocking. So what sort of demand growth we are expecting in this fiscal 25 and 26?
So the end market is still a little flattish for the regular products that we do, but clearly the new product offerings that we have made in the market, including additional business simply because of the China Plus One and the infra bill and other issues, is giving us a good fillip, and that is what we are expecting in the current financial year.
But sir, that will not be that meaningful, no, to move the needle. We need to see a growth from the base business also, right? To see a positive growth.
So, like I said, there are some soft pockets, and earlier in the previous call we had said that we were expecting growth this year in the mid-teens, but we are now reassessing that, and probably in a couple of months we would be in a more clear position on what type of a top-line growth are we be looking at for the current financial year.
Yeah, so last call you had mentioned that you are looking at the growth of in mid-teens, so that is not doable, as what you are trying to say as of now?
So like I said, we are evaluating that because, some of the end markets have softened a little bit more in the US, especially in the agriculture side. So we are evaluating that. Plus, the new business that we were expecting is also coming up a little bit more. So the net result, we are still under evaluation, but I think the growth will be pretty okay, but right now we are evaluating what the number will be, and we should be ready, Jason, to give you that information in another couple of months.
Okay. And sir, the second question is that the cash flow generation, has been quite decent. So what are we planning to do of that cash?
This is Rohit Maheshwari. The cash flow has been pretty decent in the thing. So we are using the cash flow at the moment. Certain portion of the cash flow has gone for declaring the dividends, which we declared in the last fiscal year also. We have a policy of 25% dividend. We are doing better than that. And at the same time, we are looking at the inorganic acquisition side of the business, which we have made headway, but still now work need to be done on that part.
All right. And what will be the CapEx for this year and the next year?
The CapEx for this year is about 40 crores. Normally we do 2.5% of the sales. But certain new projects which we have backed as a company, we expect the 40 crore rupees as a CapEx estimation.
All right. So just was trying to understand that still we will not be able to cross our FY23 numbers in this year also, as what I'm gathering.
Yeah, but we stated that the markets are soft in some parts of the business, especially the agri side. So we are evaluating the business at the moment, and most of the BTTs are visiting the customer. So we'll have a final assessment like we said in a couple of months.
Okay. Fine. All the best.
Thank you.
Thank you. The next question is from the line of Saurabh Jain from Sunidhi Securities. Please go ahead.
Hello. Yeah, thanks for the opportunity. Sir, extending to the question of the previous participant, I just wanted to reconfirm that you had mentioned top line growth of mid-teens for the current fiscal, and that would have included nearly 150 to 175 crore of new businesses. And also you had mentioned that 20-21% kind of margin is possible with that kind of growth. So, of course, as you mentioned that you will need a couple of more months to, reassess the outlook. But as of now, how is that 150 to 175 crore of new businesses faring up? And with 16, although we have seen a rebound in our Q4 revenue, but our margins are still at 16.4% EBITDA margins. So would you want to comment on that, both new businesses and profitability?
Yeah, hi, Saurabh. So new business, that is right, in the range of 175 to 200 crore is the number that we are expecting in the current year. It includes year 0 and year 1, what we call it. Year 0 is the first year and year 1 is the ramp-up year. So, but with this dynamic end market situation, what is happening is the timelines of implementations in some cases, get impacted. Having said that, we are also in discussion with some of the customers to expedite, on the other hand, some of the projects. So, how some timelines may get adversely impacted while some can be pulled ahead, etc. So that is something which is being evaluated as we speak. So that is one. And what, from previous time to this time, a couple of things have changed in the end market, as Gurdeep sir also mentioned. The large ag, which was, we indicated that it is likely to peak out, but definitely from then to now, clear indications of, the order books getting impacted on that front has materialized. While on the aftermarket, things are improving, so that is the green shoot that is visible. And rest of the things are looking more or less steady, but on a slightly lower base of last fiscal. So that's where things stand as of now, broadly. And on your question of EBITDA, definitely our medium-term target is to get back to 20 to 21%. But as the operating leverage comes back, so this will happen, gradually with that.
We are still getting the midterm target to around EBITDA over 20%.
Okay.
The last fiscal year has been 18.5, despite the slowdown.
Sorry, I didn't get it.
The full year FY24 reported EBITDA is 18.5. Even if we include the other income, etc., it's closer to 18.
Yeah, but for last couple of quarters, it has been at 16 and 16.4%. That's why I was, of course, you have been mentioning for your 3 years horizon EBITDA margins of 21% is, but we were more considerate about FY25 since, for last few quarters, we have been, waiting for that. Of course, the markets were not in our favor. But, sir, on a separate thing, according to the recent data released by AEM, US sales of, overall tractors, including four-wheel tractors, grew at a healthy rate in April 24, primarily driven by 100 plus HP tractors. So, but they mentioned that the smaller HP market continues to be very challenging. So, if that continues for a couple of quarters, do you think growing at single digit also would be an issue for us?
So, you're right. The April numbers came out pretty well for tractor sales for 100 plus horsepower, and it actually surprised the industry. Also, I've looked at some data on the crop sowing happening in the USA, and it's actually about 15 to 18% higher up to date than what it was last year. So definitely that's a good surprise that the market is seeing. On the small tractor, it is talking about down about 5 to 7%, but in our case, because the inventory deleverage has happened, and there is a little bit of inventory coming back, we are still looking at a flattish year for the small tractor requirements, the 3-point linkage for the small tractor. We have seen that the biggest customer in the world, John Deere, has shown a little bit lesser growth over there, but then we have another customer who's the second largest in the US, Kubota. They are in fact taking away some share from John Deere. So net to net, because both are our customers, we are seeing a flattish year in the small ag.
Okay. And so my next question is, now that inventory destocking is behind us, foray into 100 plus HP tractors has already been done. Like we have got the case New Holland, and we have also started with 3TLs for ATVs and UTVs. At the same time, we have been mentioning China plus one for quite some time. So if you can, give us some quantitative color on the same, some relevant numbers on what kind of business have we got in the last couple of years on account of China plus one, particularly in the US markets?
So what happens in the US market is that, of course, like Vivek has mentioned, that we are almost looking at close to 200 as new business for the current year. So that's a combination of China plus one. It's a combination of the infra bill, and also the fact that some of the manufacturing of made in USA or made in Europe is also shifting to India. So when we get a project, we really don't know what segment this is coming from, but overall the overall growth and the input is coming in is pretty good, And if anything, the China plus one, as you all have been reading, is only going to, the relationship is only getting worse between Europe and US and China, and we just see a lot more happening in this particular area.
Okay. And my last question, sir, any updates on other businesses apart from 3PL and PMP, like hydraulic components, fabrications, power takeoffs, any amount of businesses, if we can mention the number we have acquired in last quarter or last fiscal in the other category?
So a good positive is that on the fabrications, we are attracting some fairly good business. Some has already materialized, and some of this is close to coming in. And on the hydraulic side, we had already started with the customers, and so that part is moving on fairly good as anticipated. And but on the PTO side, the push has not been so much right now because we've been busy with the other two segments. But yeah, overall we are seeing that things are moving in the right direction for us over there.
Also, Saurabh, just to add to what I mentioned, the new account on the aftermarket side, which is the second largest store group in the US. So we commenced sales to them in Q4, and YTD calendar year sales have already crossed 500,000 with them. And obviously there will be a ramp up in coming quarters and 2 years. So the midterm, like 3 years, kind of a 2 million sort of a estimate that we provided earlier. The direction is already there.
Okay, thank you, sir. That's it from my side. Thank you. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Jignesh Gandhi from Ambit Capital. Please go ahead.
Hi. Good to see a few questions from my side. One is, if I look at our gross margins for FY24, they have come off quite materially over the last 2 years. What would be this? What would be the key reason for this? I mean, I believe there'll be some impact of mix as well, but what are the reasons you can attribute for the same?
Hi, Dinesh. Hi. So, Dinesh, broadly, gross margin has been in a stable range of a couple of percentage points and more towards gravitating towards 64%. But, over a particular year, few things impact gross margin. Like last 2-3 years were more impacted by the steel price changes. Those were happening in 21 and 22, etc. And then the freight cost, which went up quite a lot, which was also being recovered in the top line and being paid in the expenses side. So those numerator and denominator effects, generally, distort some of those gross margin figures by a couple of percentage points. And the other regular elements are the mix, as you also mentioned. Mix change a little bit, and the change in inventory also impact. But having said all of this, broadly, couple of percentage point ranging between 63 to 65, more gravitating towards 64 as being, the steady state.
Right. And second question pertains to the newer products which we are working on, not necessarily from next 12-15 months perspective, but from a medium to long term perspective. Any updates on the PTOs, 3PL for the higher HP tractors? Where are we in terms of development or testing cycle, and by when do we expect that to reflect in our P&L?
So, this is a continuing process, and we are seeing some fairly good, requirements in the plus 100 horsepower tractor range from almost 2 or 3, in fact 4 of the customers, a lot of the projects are ongoing, where it has been quoted, but they are in an advanced stage of negotiation and implementation. And so we do see a fairly good traction moving forward in that part of the segment, And like I mentioned, even on the fabrication, we have actually, attracted pretty good, what we call as RFQs, the request for quotes, which are again, liked by our customers, and we are seeing a good traction over there as well, PTO, like I said, we haven't done so much because we were so busy with the other things. And on the hydraulics, we continued with one particular customer, and there it is on an increase,
Okay. And would it be fair to say that PTO, any development will be linked to an organic initiative? Organically, it might be not that easy to have a commercial success there.
In all fairness, I won't say that, it's just that the attention on the, if the customer says, I want this and I want this and I want this, we have been looking at that more, so the PTO may have gone on the back burner for some time, but it's not by design, it's just that, we just wanted to cater to the higher demand that's coming from the, from the construction side and the fabrication side in particular.
Okay. Got it. And the last question pertains to the capacity utilization. So how it would be currently for 3PL and PNP?
So Dinesh, as you might remember from our earlier discussions, the capacity is fairly fungible. The machining, the surface finishing, the treatment, etc., are used in both. So the overall capacity is, the last year closed at around the 60% level. This is a broad approximation, a little here or there. And so there is adequate headroom as far as normal products are concerned. But obviously for few, as Rohit mentioned earlier, for few special projects, there could be some special capex. And apart from that, there will be regular replacement capex and some debottlenecking.
So you mentioned out there's a part of space of you have the delivery side. The order book comes in a better way. There's a lot of scope of improvement.
Got it. Great. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Vidhan Kumar from Chanakya Capital. Please go ahead.
Okay. So, can we get a quantitative number on the lines of the margins that we get on 3PL and precision machine parts?
Yeah. So these are in similar ballpark, and in our case, what matters or what makes a difference is how a product is being sold through which channel. And as we highlighted earlier as well, the channels that we generally follow are the warehousing channel, where we sell the product through our overseas warehouses, or the domestic, which is made in India and sold in India, and made in US and sold in US. And the other channel is direct export from India directly to the customer location. So these channels generally define the margin, and for the products, they are in similar ballpark range. And the warehousing channel is the highest margin for us, which is about 47 to 48% proportion of our sales as of now, and is in the 25 to 28% EBITDA range, depending upon the deleverage effect that you make.
Okay, so my next question would be, so the PLP business that we have, so do we have a significant competitive advantage for that? Because by the nature of that business, it seems very fragmented.
Yes, you're right. It is a fragmented space. So the advantage that we have is our existing relationships with the key global OEMs and the India base for manufacturing, and the China Plus One tailwind has been helping in recent times. And otherwise, yes, it is a fragmented market, so it's not like any player is not having a very large 20-30% sort of market share. Unlike the 3-point linkage, where there are 3 large global players, we are one of them.
The relationship is so strong that some of our customers are asked to come to Mexico, which we are evaluated in February, as mentioned in the last call. We're looking at the order book. So it's a customer-centric relationship that built over a period of 10 years.
Okay, that would be all from my side. Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Rishabh Shah from Bugle Rock PMS. Please go ahead.
Am I audible?
Yes, sir.
Sir, 2 questions from my side. How do you stand as of now in that market? Do you have any plans on increasing this segment going forward?
Sorry, your voice was not very clear. Could you repeat the question?
So how big is the aftermarket segment, and where do you stand as of now in that market? And do you have going on?
Rishabh, your audio is not clear.
Aftermarket you are checking on?
Yes, sir. Aftermarket, do you have any plans on increasing that segment?
Oh, definitely. What we are seeing is that, like you said, we already added the second largest chain in the US for that. The first one was already with us. And in fact, what has happened is that even on the inventory side where the deleverage has happened, but in this case, the swing on the other side is not taking place. And in fact, our top 3 customers, all 3 of them, 1 in USA and 2 in Europe, actually ordering more products because they feel that inventories have come down a bit too much and now they want to ramp up a little bit more. So we are seeing overall a good positive traction on the aftermarket that we would see in this current financial year.
Okay, so my second question is the new segment which you have got, supplying 3PL to UTV and ATV. How is that coming up on your target?
So yeah, as we mentioned earlier and in our presentation also, so the pilot batch for the same has already reached the about 160 to 170 stores in the USA, and it is already on the shelf and sales have started to happen. But this is a very recent development, so it will take some time for the data to flow in and exact feedback to come in. So this is a work in progress as we speak.
Okay, my last question is, are you targeting more exports and are you planning to increase your hold in any other geographies?
So geographies, we are pretty much covering all. Our geographies, it's more relevant from the point of view where the machines are getting produced and not so much where the machines are getting sold. So wherever they are produced, be it North America, Europe, India, or Japan, except China, where obviously a lot of construction machines are produced, but we don't cater too much to China. Rest everywhere we are already supplying, and we are supplying to most of the large OEMs globally on the ag side and construction side. Only one or two large names on the construction side are missing, where obviously we are trying to make inroads. But pretty much all the top OEMs are our customers. So from that perspective, our spread is pretty large, and it's about mining those accounts more and more going forward.
Vivek, I would also like to mention that recently we've already seen as a geography, South America, there is some fairly good requirements coming in. Also from the same customers that we have already, but for their manufacturing requirements, what they manufacture in South America. So that's another opportunity that's coming up. So that was an unexplored continent for us, so to say, and then we see both Brazil and Argentina, as are very large countries for agricultural produce, globally.
Thank you, sir. I'll get back in the queue.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Chirag Peloke from Ratnatraya Capital. Please go ahead.
Hi, good evening. Thank you for the opportunity. My first question was around the other expenses. They seem to have a decent uptick sequentially. Is this just because of the increase in sales that we have seen, or is there a freight component to this?
Hi, Chirag. So in the other expenses, yes, since some of the variable expenses also sit there, so because of the sequential growth, some part is linked to that. And then there is slightly higher travel expense because of the sales and BD team traveling, and slightly higher repair expenses. So those are few of the drivers.
Understood. But freight as a percentage of sales broadly in Q3 and Q4 has been similar. Is that right?
Yeah, little impact of the Red Sea charges, not a very large needle mover, but yes, there is a little one, which is recoverable, and corresponding part can generally fix in the revenue line.
Understood. My second question is, if the senior management could share some thoughts on the overall cyclicality of the business whenever we see such a down cycle, right? And the small AG tractor, at least the outlook from the largest customer seems to be pretty weak still. How long does it take typically for it to come back? What are sort of macro signals that you are looking at? Because small AG tractor sales, if I'm not wrong, is not really that much related to the agricultural demand. It's more the non-ag use case that is driving it. Could you just talk about that on a macro level? How long do you think that softness will continue? And what kind of leading indicators do you typically look for?
So, thanks for the question. What has happened is that, as you rightly said, the small tractor in the U.S. market is not a farming tractor or serious farming tractor. It's more like a tractor used by people with large properties. And this is the first time that the interest rates have gone up so much in the U.S. after I think a decade or 1.5 decades, that some of that effect is happening because of that. And we think that even though there are cycles, but this particular one is unusual because of the interest rate situation on the small tractor. And with indications that, the moment there's some indication that the Fed will start cutting down the interest rate, we see some of that coming back.
Understood. Thank you. Last question. In our overall business, what is the seasonality of Q4? Typically, is there any seasonality? Is Q4 around 25% of the year sales? I'm not talking about this year. I have obviously the report number for this year, but on a more...
Yeah, so there's no huge seasonality, Chirag. Generally, the quarters, range between 23% to 27%. Long back, post-COVID things have changed a little bit, but long back before that, Q4 used to be a slightly higher, which is more like 26, 27% sometimes. But each year could be a little different from the other. But yeah, the range is broadly, closer to 25-26%. It's not hugely seasonal. You there? Hello. Am I audible?
The next question is from the line of Jayesh from Hidden Gem Capital. Please go ahead.
Am I audible?
Yes, sir.
Hello. My question regarding what are the guidance for FY25 and 26, and also how much will be operating profit margin for FY25 and 26?
Yeah. So as sir mentioned in response to the earlier question, so complete fiscal guidance is being worked out, and will take some more time for the management to get back to that. And I mean, broad, the end market dynamics and the business operating environment has been explained already. So we are not putting a particular number to that just now. And so is the margin, because that operating leverage coming back, it is slightly linked to that.
And how much is the order book right now?
So okay, so we get regular orders, so there's no long-term order book that is available. The association with most of our OEM customers is very, very long-term. I mean, most are there with us for 15 to 20 years. And depending upon their sales, we get a visibility of anywhere between 6 months or 3 months to 12 months, depending on which customer operates in what manner. But there's no particular order book number that we are able to give out at any time.
Okay. And sir, one more question: how much is the replacement cycle for 3PL and for other parts like precision parts in engineering sector? How much is the replacement cycle for these parts?
So for 3-point linkage, typically it is anywhere between 7-8 years or so. But it's a combination of 8-9 sub-parts. So there's a possibility that one of the sub-parts breaks and that gets replaced. So it's not always that the entire hitch gets replaced. It is sometimes 1 or 2 parts get replaced. So that's kind of a problem. While on the other hand, the PMP is slightly less than that, because these are the joints where the load bearing happens. And the replacement market for PMP is more through OEMs themselves. And on the other hand, on 3PL side, there is a large aftermarket, organized aftermarket also out there.
Okay. And my question is about dividend policy. Will the Uniparts continue with its dividend policy? Because post IPO, the financial is not that great by sequential, by quarter, and FY compared to FY23 and 24. So will the dividend policy continue?
Definitely it will. In fact, our stated dividend policy is 25%. We did about 40% last year, and even for the current year, we think we should be in the same percentage, simply because the cash flows generation is pretty good. Yeah. So we've had, in fact, last year the cash flow was, like mentioned, is about 200 crores. So clearly, we see the dividend policy continuing and probably in the range of 35 to 40%.
We identify the target in the organic space. That might change slightly a bit, but otherwise we'll continue on that one.
Okay. My last question is about the IPO listing time actually. And following Uniparts from last 1 year also, and also attending various conference calls. Do you think that during the IPO listing, the operating profit margin was about 22-24, I guess. I think that was because of COVID impact. And now the operating profit margin is about 14-16 now because of the you can say a down cycle or maybe a normal business of Uniparts. Don't you think so the IPO timing of Uniparts was not a true picture of the Uniparts because that was one of the event of COVID. That's why the operating profit margin was better.
No, so even during the IPO times, the management was very clear that the 23% or above, which was, getting reflected for a few quarters, was having certain tailwinds. And, the real EBITDA levels were closer to 21, which was, at the, let's say, around the FY23 revenue levels. From there, things have declined 16 to 17%. So obviously the operating day leverage is playing out. So our medium-term target is to get back to that 20-21%, which we believe at that kind of a revenue level is a steady state.
Okay, thank you. And best of luck.
Thank you.
Thank you. The next follow-up question is from the line of Rishabh Shah from Buggle Rock PMS. Please go ahead.
Thank you for the opportunity. My question is, which are the major sectors contributing to our revenue? Are we planning to expand our reach into various other sectors?
You were not very well audible. Could you repeat the question once?
The question is, are the major sectors contributing to our revenue? And are we planning to expand our reach into various other sectors?
Are you talking about inorganic?
Yes, sir, inorganic.
Inorganic. Okay, inorganic.
So we are very clearly laid down the verticals what we want to expand in. It will be ancillary to the verticals what we are operating in at the moment. We have mentioned it towards the hydraulics or the PPO part of the business, where we can leverage on our manufacturing strength and our relationship with our customers. It is just like ensuring what we always call a dual shoring model, and that is our USP model, and we want to operate in that segment. And that's the area we are looking for in our growth globally.
So what is the contribution towards our revenue from the top 3 of your customers?
So the top 10 customers are about 76-77%. Top 5 are closer to in the 55 to 60% range, all put together.
Okay. And my last question is, with the introduction of new products, how much additional revenue are we able to clock, and how much additional market share are we able to gain?
Is that again linked to your inorganic question?
Yes, sir.
So that will be driven by the size of the target that we find.
So anything in pipeline, sir?
And obviously the intent would be to.
It's like building up a vertical in that slide. If you want to do in the hydraulics, that's a new vertical that will be a sizable one in that. Because organically it will take time to build it up. That's why we are looking in that area to build it up.
Thank you so much, sir.
Thank you. The next question is from the line of Darshil Zaveri from Crown Capital. Please go ahead.
So thank you so much for taking my question. Hope I'm audible.
Yes.
Yeah. So just wanted to know, a lot of my questions have already been answered. Just wanted to know, so currently, if you would have some visibility of Q1 and Q2, will we say it's larger, mostly flattish as compared to 24. Would that be a fair assumption?
So, as of now, I mean, we would not like to comment beyond Q1 for stated reasons earlier. Q1 could be, sequentially broadly flattish in that range.
Okay.
And beyond that, we are evaluating and we'll revert in due course.
Fair enough, sir. So we would assume the currently margins will also be around 16% only, right, sir?
Yes, in that ballpark.
Okay.
We are working on various, cost optimization efforts, so those can add. But broad ballpark is, you can take that.
Okay. Fair enough, sir. Okay, that's it from my side. So all the best, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Ronak Mehta from JM Financial. Please go ahead.
Yeah, hi. Thanks for taking my question. Just a clarification, you just said that 1Q will be flattish on a YY basis or sequentially?
Sequential, Ronak, although YY and sequential, there's not huge difference, but I meant more sequential.
Understood. Okay. So I have a couple of questions for Gurdeep ji. So firstly, can you talk about the new order wins that have happened in the last couple of quarters, given that there's a lot of traction from China plus one thing that is happening? So any new order wins or increase in the wallet share with existing customer where that you have gained market share, something to highlight?
Like I said, the overall, we are looking close to a 200 crore figure, and this is only changing month on month because there are so many new codes and things that are happening, and they are happening much faster than what they were earlier, because of the market conditions. And it's coming, in fact, while we keep saying China plus one and that is happening, but it's surprisingly coming a lot also because what is made in USA or made in Europe, that is also we are seeing a lot of traction coming to India where they are finding manufacturing is getting on to be far more expensive and people availability in this particular industry is not so good,
Okay, so most of them are at RFQ stage and there's no concrete orders as yet, right?
So, and what I said was that we were already looking at we got a big thing about close to 200 crore of, let's say, firm up, business, which is new business. But it's not going to stay there because it continues to, new RFQs getting quoted, and some of them that were quoted 1 or 2 months ago, they are likely to come through as well, So there's a continuous kind of a traction that happens.
So, so Ronak, just to add to what Charles just mentioned, just to clarify, there is a stage called award of business. So, award, once the business is awarded, so that 200 crore number is more on, talking about that stage. Post that, the real purchase orders follow in due course, right? Which is, and then gradually the ramp up happens. So, broadly, that's how the process evolves.
Understood. Okay. So my next question is on the slightly longer term strategy for the company. Given that OHV is a fairly cyclical business, any thoughts on entering a new segments like CVs or PVs? Because there's a lot of traction from global companies to set up manufacturing to source more from India. And some of your peers in the forging space have been talking about that, and they are consistently winning new orders and growing at a fairly decent pace. So, any thoughts on that?
So, the main focus is still the off-highway market, which we are operating for the field. But at the end of the day, we are also an engineering company dealing with 12,000 plus SKUs. So, we are looking at certain areas in this sector, and of course, demand outlook is positive out there. But we are not at the moment centered on something which you want to diversify more. But obviously, we are in our evaluation.
Okay, thank you.
Over here and something that, Vivek and Rohit may not know of, but, the largest construction company in the world who is our customer, they always thought we do the PMP sort of thing and everything, but the key people came and visited our Ludhiana facilities, and they were surprised to see our forging capabilities and machine forging capabilities, and just 2 weeks ago they have, approved us for that, and they say, hey, this is another area that is going to open up for us to give you new business, So that's a pretty interesting development over there. So you mentioned the word forging, and that's why I thought let me talk about it,
All right. Yeah. Thank you for that. Yeah.
Thank you. The next question is from the line of Rajesh Mangal Agarwal from Rajesh Mangal and Company. Please go ahead.
Yeah, good evening, sir. Thanks for the opportunity. Sir, I am attending this con call for the first time. So, why this ROC has been reduced from 36% to 20%? Can you brief about it, sir?
Yeah, so it is because of the decline in the numerator because of the operating deleverage, while the denominator has grown obviously because of the retained profits. So both numerator and denominator are temporarily impacting adversely.
Okay, thanks. And second thing is, sir, what sort of PLI benefits we are availing from Indian government?
No, there's no benefit as of now.
There's no government benefit except the duty drawbacks.
Okay, sir, in this agriculture equipment, etc., we are not having such a benefit?
No, there is no benefit announced by the government of India. This is PLA benefit scheme in this particular segment.
Okay. Thank you, brother. All the best, sir.
Thank you.
Thank you. The next question is from the line of Anu Jindal from Thorin Technology Solution LLP. Please go ahead.
Sir, most of my questions have been answered. Just two questions. The first is, out of the 46% share of 3PL, how much was greater than 70 HP? Like, have we made any sales for the 3PLs which are greater than 70 HP? That is my question. Hello.
Yes, yeah. So we already do at component level. We have been doing for some time. While some of the new orders or awards have been for the more complete system, which are in this stage of getting implemented. But at a component stage for large tractors, high HP 3PL, we already do sales. Over there, our share is broadly 7 to 8% kind of. Yeah.
7 to 8% of the 3PL sales or for total sales?
Of the market size, the mapped OEM market size for large tractors.
Got it. And my second question is again, just, it has been asked earlier also in this con call, like, to counter the cyclicality, obviously we understand that, US agriculture has been not doing that great and interest rate cycle is yet to reverse. So countering the cyclicality of the agriculture industry, like what are the long-term views of the company? How do we plan to adjust to the down cycle of such industries?
So, 2-3 things over here. See, the diversification which the company has been able to do over the years and adding new customers has helped. As you may observe that, last year's proportion between 3-point linkage and PMP versus this year, the FY2024 completed year, there is quite a change. But what has happened is, while the 3-point linkage remained weak, which is, the tractor cycle remained weak, but the construction cycle did well in the last completed fiscal. So that helped, right? Then also the account additions have been helping. So those are the things, which help in diversifying and de-risking the business more and more. And we continue to, work on further new accounts. and new business and new projects obviously will lead the growth.
Got it. And you mentioned TMT parts in your presentation. It is for construction industry only, right? Like remaining 53% revenue contribution of TMT, that is majorly for construction industry, or TMT is also shared by some by agricultural industry?
It is largely for construction. Few agriculture machines also, include TMT, but that's a smaller portion. Some of the larger machines, agriculture machines use TMT, but it's predominantly the construction industry.
Sure. And the very last question, sorry for that again. The very last question is it like the PMT customers which take the PMT parts from you, from Uniparts, is it due to like the advantages due to the engineering capabilities as is there in 3PL, or is it something else? Like, why would they primarily come to you, Uniparts, as compared to other Indian players? Like, if we discount the China plus one, like, is it the engineering capabilities, or is it the like customization which you provide? Like, what is the exact reason? If you can just throw a bit of a light there.
Okay, thanks for the question. See, first of all, just remember that we are catering to the top companies in the world, and engineering capability and quality systems are taken for granted. You have to have that, otherwise you cannot do it, But most of the products that the new business that we get, we are also getting of the fact that it's made in those countries, or it's China plus one effect. But we in India are the only one per se to offer low-cost manufacturing globally with these kind of parts. And add to that the fact that we are doing so much of our business through the warehousing, we have taken the distance out of the equation. It's almost like having product next to the manufacturing locations in USA and Europe, where we can just supply on just-in-time deliveries. So the warehousing model coupled with low-cost manufacturing in India, and like I said, the engineering and quality systems, if you didn't have that, you would never get into this business in any case. That's the way I put it.
Sure. Thank you. Thank you, sir. That answers my question, and we will be awaiting for the guidance maybe in the next one.
Definitely. Sure.
Thank you. Ladies and gentlemen, you may press star and one to ask a question. As there are no further questions, I will now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you so much, and I'm really glad talking to investors and potential investors. But for all, I would like to reiterate that the company remains committed to maintaining our high quality standards and delivering exceptional outcomes. We continue to focus on strengthening our customer relationships and leverage our core capabilities to partner our customers in their journey and success. Our focus and efforts are aligned with the medium-term business plan for achieving the targeted growth in the coming years. Gentlemen, ladies and gentlemen, with this, I would like to thank you all for taking out the time for today's call. Thank you very much.
Thank you. On behalf of Go India Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.